Hello, my dear students, first year English section. This is Fatma Mahmoud Amara, and I'm really happy to be with you for the second term in the accounting course, inshallah. And it was a great, such honor to be with our professor, Dr. Abdul Habib Shaheen, the course professor, and our course is going to talk about the partnership accounting. In the first term, we talked together about the proprietorship or sole proprietorship accounting. معنى محاسبة الأفراد أو محاسبة الأشخاص. هنا this term إن شاء الله we will talk about محاسبة الشركات اللي هي البارتنرشيب الشركاء. Our course professor is Dr. Abdelhamid Shaheen, the head of accounting and auditing department and the dean of faculty of commerce, Sadat City University. This is considered as section 2 in chapter 1 because I uploaded a file on our group on Facebook 3 days later, and I hope you revise it. It was a very simple file about the meaning of partnership and the partnership agreement and some theoretical definitions. Today, inshallah, we are going to talk about some practical examples, and we will solve in the test bank questions in your book, inshallah. Let's start. Example number 1. Martin and Adam combined their proprietorship to start a partnership named US Software. Martin and Adam have the following assets prior to the formation of the partnership. Prior to the formation meaning before the formation of a partnership. So Martin have sub assets and Adam have some assets prior to before the formation of a partnership, and this table shows us these assets and the value of each asset, one by book value and number, and second column by the fair value, such as cash for to Martin was $8,000 in book value, and in fair value or fair market value where the cash was $8,000, and so on. And we need to prepare, the required here is to prepare the entry to record the investment of Martin and to prepare the entry to record the investment of Adam. For the first time in the first example, we need to understand what we are going to do, and I'll explain it in this example. First, as two persons are going to form a partnership together, each person have its own assets before the partnership, before forming the partnership. So we need, in order to inform a partnership, we need to know by how much each person is going to share in this partnership. So we need to calculate what is the investment of Martin in the partnership, and what is the investment of Adam in the partnership, and this is our required. Prepare the entry to record the investment of Martin, by how much Martin will going to share in the partnership, informing this partnership. Martin will give the partnership, or Martin will share by cash by $8,000, and here we are going to take the fair market value, not the book value. So we will take the numbers by the fair value, not the book value. So Martin will share. I'll shade it by the red color here. We are going to take this 8,000 by the fair market value. We are not going to deal with the book value. So Martin, we will share by cash, which equal $8,000, and equipment by $4,000, So Martin will invest or will share in the partnership by $12,000. So Martin investment in this partnership will be $12,000. So we will record this investment as this entry shows. From cash by $8,000 in the debit side and equipment by $4,000 in the debit side, to Martin capital in the credit side, $12,000. And as we showed in, or as we explained in the first term, when cash increased, it increased in the debit side. So when Martin will share by cash and equipment, so Martin will increase the assets in the partnership. So the assets in the partnership are going to increase. So we record the cash and equipment in the debit side. And also when Martin share in the partnership, so Martin will invest $12,000. So Martin capital will increase in the credit side. So we will put Martin capital in the credit side by increase, as the accounting equation states, as we explained before in the first term. The same thing we are going to do with Adam. We need to record the investment of Adam, by how much Adam will going to share in this partnership. Adam will share by what? Adam will share by a cash of $9,000 here in the by the fair market value, 9,000, and I'll show it in the yellow color, $9,000. And we and also he will share by accounts receivable, and accounts receivable by $4,000 he will share, and there is allowance for doubtful accounts by $1,000, and this will decrease the amount of accounts receivable. So we are going, Adam will going to share by cash by $9,000 and accounts receivable by $4,000. So the cash will increase by, in the partnership, will increase by $9,000, and the accounts receivable will increase by $4,000. And the allowance for doubtful accounts will also increase by $1,000, and this allowance will decrease the amount of accounts receivable. So the net account receivable here will be $3,000, which stated by accounts receivable $4,000 minus $1,000. So the net accounts receivable will be $3,000. But here we recorded it in the credit side because it decreases the account receivable. So the summation of Adam capital will be $12,000. Will be $12,000. I hope you understand this example and understand this point. Let's move to another example. The beginning capital balance is $47,000 for Arpor and were $36,000 for Baronet. The ABC company has a net income of $32,000 for the year 2012. The partner Arbor and Baronet, which we use the abbreviation of AB company here, share the net income and loss equally. Drawing for the year were 8,000 for Arbor and were 6,000 for Baronet. We need to prepare the entries, the closing entries for this event, and we need to post to Ledger. Here, the beginning balance of capital was $47,000 for A, and $36,000 for P. This is the beginning balance, and the net income was $32,000. And he said here that partner share net income. I'll color it by the red color here. It shares the net income and net loss equally. So that $32,000 net income will be shared equally between the two partners. So each partner will have 50% or will have $16,000 from this net income. And we need to prepare the closing entry for this. So the entry will be as follows: from income summary to Arbor capital and parent capital by the amount of each partner share. Here I divide the net income between the two partners by the percent of 50%. Each partner will have a half. Here we prepare the closing entry from income summary in the debit side, and Arbor capital in the credit side, parent capital in the credit side. After that, we need to close this capital, and close the amount of drawing. So we close drawing in the credit side because its nature was a debit side. So when we close it in the credit side, in the opposite side of its nature. So we will close drawing as this entry shows, from Arbor capital by $8,000 to Arbor drawing $8,000, and parent capital $6,000 to parent drawer by $6,000. And after we prepare closing entry, the required number B is post to Ledger. We need to post this actions or these events to the Ledger account. T account Ledger. Did you remember it? Do you remember? We said before we have simple form of Ledger, which is T account, and we have standard form of Ledger, which is more compound, like this. I hope you remember it and revise it from the first term because it's really important. Here we will open a T account Ledger to the Arbor capital. A beginning balance minus الكلوزنج minus الدروينج اللي احنا قفلنا اخدناها منه ب 8000. يبقى اذا الكلوزنج closing balance will be $16,000. After that, we opened the T account for parent capital. Beginning balance was $36,000, and he made a drawing by $6,000, and so the sorry for being interrupted. Okay, we are going to open a T account for each partner capital. Number one is airport or partner A. The beginning balance for capital was for $47,000, and he will increase this capital by his share of income, which is $16,000, and he will going to draw $8,000. So he will increase the capital in the credit side by the amount of net income and decrease the amount of this capital by the amount of drawing, as we said. So the net balance or the ending balance for the capital will be $55,000. And the same thing we are going to do with the B capital or the partner number B. The beginning balance of the partner number B was $36,000, and he will increase this amount of capital by his share of net income, which is $16,000, and he will withdraw or make drawing by $6,000. So he will increase the amount of capital by the income and decrease this amount by drawing, so the ending balance will be $46,000. And also we will open a T account for each partner drawing, A drawing and B drawing. And as we said, drawing its nature is debit side, in the debit side because it's decrease the capital. So when we close it, we will close it in the opposite side or in the credit side. I hope you understand this point and solve many questions and solve many problems and practice on it more and more. So let's move to another part in our question, which is the multiple choice questions or the test bank questions in your book. And this is an important questions for the final exam, inshallah. Let's start with number one. The partnership agreement should include each of the following except the partnership agreement, which we take it in section number 1, should include each of the following except ما عدا, except the surviving family members in the event of partners death. All of these elements are included in the partnership agreement except number C. Number 2, Ali is investing in a partnership with Dina. Ali contributes a part of his initial investment, which is accounts receivable by $120,000. Accounts Ali will share in the partnership with Dina by accounts receivable, which value by $120,000, and allowance for doubtful accounts by $18,000 and $12,000 cash. So the entry that the partnership makes, he need here the entry that the partnership makes to record Ali investment. He need here the entry. Ali is going to join in the partnership. So the accounts receivable will increase and the cash also will increase in the debit side. And in the credit side we will have the allowance for doubtful accounts and the amount of capital. So let's here calculate the amount of doubtful amount of accounts receivable or net accounts receivable after subtracting the allowance for doubtful accounts. So the capital will be equal, number one, account receivable equal $120,000 minus $18,000. It will give us $102,000 plus $12 cash. So the amount of capital will be $114,000. So the choice will be number C, credit capital by $114,000. So we will choose number C. Here I solved it as follows. I subtracted the amount of doubtful allowance for doubtful accounts from the accounts receivable, $120,000 minus $18,000 allowance for doubtful accounts equal $102,000. This is the net accounts receivable, 102. This is the net accounts receivable. Net accounts receivable plus, so he will share accounts receivable and a cash plus the amount of cash $12,000. So the total capital will be $114,000. So the choice will be number C. Okay, let's move to number 3. Shadi is investing in a partnership. Shadi is investing in a partnership with Mohsen. Shadi contributes equipment. هيشارك we will going to share by equipment. The original cost of this equipment is 84,000 livres Egyptians, have a book value of 40,000 livres Egyptian and a fair value of 52,000 livres Egyptian. The entry that the partnership make to record Shadi's initial contribution. So the entry will be Shadi will contribute by an equipment. The equipment have original cost and have a book value and a fair value. As we said in exercise number 1, we will deal with the fair value. We are not going to deal with the book value or the original cost. So the equipment will be debit equipment by $52,000 by the amount of the fair value, and I'll color it, I shaded it by the red color or the yellow color here. From the question, I didn't calculate anything, I take it from the question. So the answer will be debit equipment by 52,000 livres Egyptian. So the answer will be number C. Number 4, a partner invests into a partnership a building with an original cost of $180,000. The building original cost by $180,000 and accumulated depreciation of $80,000. This building has a 140 fair value. So the fair value is 140. We agreed that we deal with the amount of fair value. We don't deal with the book value or the original cost. As a result of investment, the partner capital account will pay. So the partner will pay increase by the amount of fair value 140 from the head of the question number A. So the answer will be number A. Number 5, Hussam and Salah are forming partnership. Hussam will invest a truck. Hussam will invest a truck with a book value 20 livre Egyptian and fair value of 28. So as we agreed before, we will deal with the fair value. Okay. So that Hussam will share by a truck. Its value is 28,000 livre Egyptian. Salah will invest a building with a book value of 60,000 livre Egyptian and a fair value of this is the share of Salah. A fair value of 84,000 livre Egyptian with a mortgage of 30. This building have a mortgage of mortgage رهن عقاري of 30,000 livre Egyptian. So what amount should the building be recorded? What amount should be the building? So the building will be recorded by the fair value minus the amount of mortgage. So the building will be recorded by the amount of fair value fair value minus the amount of mortgage. The fair value is $84,000 minus the amount of mortgage is $30,000. So the building will be recorded by $54,000. Will be recorded by $54,000. $54,000. The answer will be number P. I hope you understand this questions. See you in the next section, inshallah.